If this were just another prediction, you could ignore it. If this were just fear-mongering, markets would already be panicking. But that's not what this is, because what's coming next doesn't arrive as a surprise. It arrives as a pattern, and patterns don't announce themselves, they repeat. Look back for a moment. 1929, the world believed prosperity was permanent. Markets were strong, confidence was high, warnings were dismissed as pessimism. Then came the collapse. 2008. Again, the system looked stable until suddenly it wasn't. Real estate cracked, banks froze, liquidity vanished almost overnight. Different decades, different triggers, same outcome. And now we're staring at another date being quietly added to the timeline. 2026, not as a prophecy, not as a countdown clock, but as a convergence point. Because unlike 2008, what's forming now isn't one crisis. It's several, moving toward each other at the same time, and that's the part most people miss. In 2008, there was a single epicenter, housing. Everything else was downstream from that one break. Today, there is no single fault line. There are many. And they're all under stress simultaneously. What makes this moment dangerous isn't panic. It's calm. Markets are still trading. Banks are still open. The dollar still looks strong. And that's exactly why people underestimate what's building underneath. Because real systemic shifts don't begin with explosions. They begin with pressure. Pressure that builds quietly. Inside balance sheets, inside debt markets, inside consumer behavior. By the time it becomes visible, options are already limited. This video is not about predicting a crash. It's about understanding why the next crisis won't look like the last one, and why comparing 2026 to 2008 actually understates the risk. Because in 2008, policymakers had room to maneuver, interest rates could be slashed, debt levels were lower, inflation wasn't a constraint. Today, that flexibility is gone. The system is more leveraged, more interconnected, and far less forgiving. And most importantly, the stress is not concentrated in one place. It's spread across four critical pillars of the economy: commercial real estate, equity markets, government debt, and the consumer. Each one of these on its own would be manageable. Together, they form something far more unstable. This is why 2026 matters. Not because it's a magical year, but because it's when multiple cycles collide. Debt matures, bubbles stretch, consumers hit limits, and policy tools lose effectiveness. History doesn't repeat itself cleanly, but it does rhyme. And right now, the rhyme isn't collapse, it's compression. Every major financial crisis has a starting point, not the moment it becomes visible, but the place where pressure quietly begins to leak into the system. For the next cycle, that place is not housing, it's commercial real estate, office buildings, shopping centers, downtown towers that once symbolized economic power. For decades, commercial real estate was treated as one of the safest assets in finance. Long leases, predictable cash flows, stable valuations. Banks loved it, pension funds relied on it, insurance companies built portfolios around it. But that stability is breaking, slowly and unevenly, and that's exactly what makes it dangerous. By 2026, nearly $1 trillion in commercial real estate debt is scheduled to mature. This isn't future borrowing. This is old debt coming due. Debt that was issued when interest rates were near zero. Debt that assumed buildings would stay full. Debt that assumed valuations would keep rising. None of those assumptions hold anymore. Office vacancy rates in major cities are at historic highs. Remote work didn't just change behavior, so it changed demand permanently. Entire floors sit empty. Leases aren't being renewed. And properties are being revalued far below their previous prices. Here's where the system starts to fracture. When a building's value drops below the loan attached to it, owners face a decision: inject more capital into a losing asset, or walk away. And increasingly, they're choosing to walk. Not because they're reckless, but because the math no longer works. Banks are quietly receiving keys instead of payments. No headlines, no chaos, just defaults that don't make the news. This is why commercial real estate is often called a slow-moving crisis. The losses don't appear all at once. They surface gradually, quarter by quarter, inside regional banks, private lenders, and pension funds. And that matters because, unlike 2008, the risk isn't concentrated in giant institutions alone. It's spread across hundreds of smaller banks, banks that dominate local economies, banks that fund small businesses, banks that don't have access to emergency bailouts. When those banks tighten lending, the effects ripple outward. Credit dries up, refinancing becomes harder, economic activity slows, quietly but persistently. And here's the critical difference from 2008. Back then, falling real estate prices triggered panic. Today, falling prices trigger denial. Because the system can absorb losses, as long as they remain slow. But slow doesn't mean harmless, it means corrosive. Commercial real estate isn't collapsing in one dramatic moment. It's eroding. And erosion weakens the foundation long before anything falls. This is why 2026 matters. not because buildings suddenly implode, but because refinancing windows close. Debt matures into a market that no longer exists. And when refinancing fails, defaults follow. Not explosively, systemically. And commercial real estate is only the first pressure point. Because while buildings are empty, something else is inflating rapidly above them. The stock market. And that's where the next imbalance appears. On the surface, everything looks fine. Stock indices are near all-time highs. Headlines talk about resilience. Analysts say the market has priced in the risks. But this is exactly how dangerous periods look before they break. Because strength in markets is not about levels, it's about structure. And structurally, today's stock market is more fragile than it appears. The clearest signal is something most people never hear about: the Shiller P/E ratio. This metric smooths earnings over a decade to remove short-term noise. Right now, it's hovering near 40. In modern history, that has happened only twice before: 1929 and 1999. Both were followed by crashes that reshaped the economy. This doesn't mean a crash happens tomorrow. It means the market is priced for perfection. And perfection leaves no margin for error. But valuation alone isn't the real problem. Concentration is. Today, the majority of market gains come from just 7 companies, often called the Magnificent Seven: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla. Together, they dominate indices, retirement accounts, and ETFs. When they rise, the market looks strong. But beneath them, most stocks are flat. Some are already falling. This creates a dangerous illusion. Investors believe they're diversified, but in reality, they're crowded into the same trade. If even 2 or 3 of these companies disappoint, the effect isn't localized. It cascades. Index funds sell. Algorithms react. Passive investing turns active, all at once. This is why modern crashes move faster. Not because fear is higher, but because positioning is tighter. And there's another problem that didn't exist in 2008: interest rates. In past cycles, the Federal Reserve could step in aggressively, cut rates, inject liquidity, stabilize markets. That option is no longer unlimited. With inflation still a threat, the Fed can't easily flood the system with cheap money without consequences. That changes the psychology of the market. Investors know the safety net isn't as deep, so risk tolerance becomes brittle. Confidence exists, but it's conditional, and conditional confidence breaks faster than blind optimism. This is why volatility spikes on good news. This is why rallies feel nervous. This is why markets react violently to small surprises. The system is balanced on expectations that assume nothing goes wrong. But something always does. And when it does, the selling won't start because people are scared. It will start because they all realize the same thing at the same time. There's no room left. The stock market isn't just expensive. It's narrow, leveraged, and dependent on belief. And belief, once shaken, doesn't decline gradually. It snaps. Which brings us to the mechanism that ties everything together. The force that turns market stress into a systemic loop. Debt. Every crisis has a trigger, but every systemic crisis has a loop. And right now, the United States is trapped inside one. It's called the debt doom loop. Here's how it works. Simply, the U.S. national debt is now approaching $38 trillion. That number is so large it's lost emotional meaning. But the interest on that debt hasn't. The government is now paying over $1 trillion per year just in interest. More than national defense, more than most social programs. And that's the key problem. Because interest is not optional. It must be paid, regardless of growth, politics, or promises. So what happens when interest costs rise? In a normal household, you cut spending. In a normal business, you restructure. But the U.S. government can't do either easily. Social Security, Medicare, defense, debt interest. Most spending is mandatory. So when interest costs increase, the government doesn't reduce debt. It issues more debt. New borrowing is used to service old borrowing. That's the loop. More debt, more interest. More interest, more borrowing. More borrowing, even more debt. This is not a theory. It's already happening, and it's accelerating. Now, here's why 2026 matters. Between now and then, trillions of dollars of U.S. debt must be refinanced. Debt issued when rates were near zero is rolling over at much higher rates. That means higher interest costs, less fiscal flexibility, more pressure on the system. And here's the catch most people miss. The Federal Reserve cannot solve this. If the Fed cuts rates aggressively to reduce interest costs, inflation reaccelerates. If the Fed keeps rates high to fight inflation, debt service explodes. Either path creates stress. This is what economists call fiscal dominance. Monetary policy becomes constrained by government debt. The central bank stops leading and starts accommodating. That doesn't cause an immediate collapse. It causes distortion. Asset prices stay elevated longer than they should. Risk mispricing persists. Savings lose purchasing power. The system remains stable, but unstable underneath. This is why the debt ceiling drama always ends the same way. They argue, they posture, they warn, and then they raise the ceiling. Because default is not an option, and austerity is political suicide. So the only path left is rolling forward, extend maturities, absorb costs gradually, let inflation do part of the work, not loudly, not dramatically, quietly. This is why America's debt doesn't look like a crisis. The pain isn't concentrated, it's diffused, across time, across savers, across asset prices, across future growth. But diffusion doesn't eliminate cost, it just delays recognition. And delays always make systems more fragile, because eventually confidence starts asking a dangerous question. Not, can this be paid? But, how long can this be rolled? That's when markets begin to behave differently, not in panic, in preparation. And that leads us to the final pressure point, the one closest to everyday life, the consumer. Every financial system can absorb pressure, but only as long as someone is still standing underneath it. And today, that someone is the American consumer. This is the final piece most people underestimate, because markets can stay irrational, governments can roll debt, banks can extend credit, but consumers can't refinance reality forever. Right now, the warning signs are no longer theoretical. Auto loans are at record levels, credit card balances are at all-time highs. Interest rates on consumer debt are the highest in decades, and delinquencies are rising, quietly but steadily. Subprime auto loan defaults are now at levels not seen since the mid-1990s. That matters, because the U.S. economy doesn't run on exports. It doesn't run on government spending alone, it runs on consumption. Nearly 70% of U.S. GDP depends on the consumer. And here's the uncomfortable truth. The consumer is no longer being supported by income growth. They're being supported by credit. For years, rising asset prices masked this problem. Homes went up, stocks went up, portfolios looked healthier, so spending continued. But credit-fueled consumption only works when borrowing is cheap, and that era is over. Today, consumers are facing higher interest payments, higher housing costs, higher insurance costs, higher food and energy prices. At the same time, savings buffers built during 2020 to 2021 are largely gone. This is what a breaking point looks like. Not panic, not collapse, compression. People don't stop spending all at once. They downgrade, they delay, they stretch payments, they miss one bill, then another. And because this happens gradually, it doesn't trigger headlines. But it shows up in data. And it's showing up now. This is why 2026 matters. Not because it's a prediction, not because it's a deadline, but because it's where multiple pressures converge. Commercial real estate refinancing stress, equity market concentration risk, government debt rollover at higher rates, consumer credit exhaustion. In 2008, the crisis was narrow. Housing broke. Everything else followed. And the Fed had unlimited ammunition. Rates could be cut. Liquidity could be injected. Balance sheets could expand. In 2026, the problem is broader, and the tools are weaker. Inflation limits aggressive easing, debt limits fiscal response, confidence limits tolerance. That doesn't guarantee collapse, but it guarantees fragility. And fragile systems don't need big shocks. They need small ones in the wrong place. A regional banking issue, a funding stress, a consumer pullback, a policy misstep. That's how systemic events actually start. Not with explosions, with erosion. So what's the real takeaway? This isn't about fear. It's not about timing a crash. It's not about betting against America. It's about understanding structure. Because once you see the structure, you stop asking, when will it happen? And start asking, what happens if stress increases just a little? That's the mindset difference between reaction and preparation. The goal isn't to predict 2026. It's to recognize that the system is no longer forgiving. Debt rolls forward. Markets stay elevated. The dollar still looks strong. But underneath, tolerance is lower. Margins are thinner. Mistakes matter faster. That's not collapse. That's transition. And history is very clear about one thing. Transitions reward those who see them early, and punish those who assume nothing will change. 2026 isn't a prediction, it's a pattern. And patterns don't announce themselves. They reveal themselves, slowly. If you understand that, you won't be surprised by what comes next. You'll be prepared. If this series helped you see the system more clearly, comment "system" below. And if you want more breakdowns like this, without noise, without hype, without fear, subscribe to AG Currency.